Hey, Carmen, thanks so much for being on the show. If you could please introduce yourself to the audience and tell us a little bit about how you got into real estate.
Sure. I'm Carmen Dettloff with Bigfoot Equity. I'm the founder of Bigfoot Equity, and I have been working in real estate now for about 15, 20 years. I started, just with one single family after I, read the Rich Dad Poor Dad books like everybody else and got inspired. And we started small. And then we got to a point where we had, all of our, we had enough underneath, four underneath Sean's name, and then we had some underneath my name. And, we felt really good. And then we really felt like we were on top of the world. Sorry, this is like long introduction. Is that okay?
No, no, yeah, please,
Okay.
please.
Okay. So we're feeling like on top of the world, and we're making cash flow, a little bit of cash flow, right? And felt like we were dominating. And then I started listening to some stuff about multifamily, and I was like, well, we can't do it because we don't have enough money, and blah, blah, blah. And then I started chatting with more multifamily people. I'm like, whoa, they are crushing it. They're making my, what I felt like was a single family empire seem very small. And so we're like, we kind of need to pivot. And so we decided to sell all of our single families and roll those into a multifamily property. And we were so thrilled. And I watched the process. And at that point, I decided to quit my job as a professor to do this full time.
That is awesome. I'm a big believer in story, and I like studying story. And it's just so cool how that was your mindset back then, and now we'll talk about where you are today. But just the transformation, that's awesome. I
Yeah.
love that. So to back it up a little bit, I know you were a mathematician in your past life, and you still are in
Yes.
underwriting, but you were a teacher and things like that. Can you just provide some context into what you did before real estate?
Sure. Yeah. Before I did real estate, I have a degree, a master's degree in applied mathematics, and I worked at a bank forecasting how much money we're going to lose on bad loans. And obviously, I didn't do a very good job because that bank went out of business. And then I got a job at an airline, and I worked for other airline industries working related programming for revenue optimization. So you know how airline ticket prices change all the time. I worked on the software that changed the ticket prices to maximize revenue and maximize butts and seats.
Nice. So you're responsible for all these high and increasing
Yes.
flight tickets.
Yeah, I worked on the program at some point. I'm sure the software is
Yeah.
still being used. Yes.
Oh, that makes sense. That's awesome.
Yep.
And I know you mentioned that you lost your job at the bank when it went under. I think in the past that was kind of like a catalyst for you realizing how unstable a job is, and not just any job, but like it's why it's important to have multiple streams of income. Can you kind of dive into what that experience was like and how you pivoted to make sure you're kind of insulated from that potentially happening again?
Absolutely. So when I was laid off from the bank, every other person in my department was laid off. They were all mathematicians, statisticians. And you know what? There's only so much demand for mathematicians, statisticians in Seattle. And so like 80% of people moved, 10% of people didn't find new jobs, and 10% of people had to get jobs in different industries. And I got a job in a different industry. So I was very lucky. But I really saw how short-lived it was. And then at the same time, my husband, he let go of 60% of his staff. And and it was indiscriminate. It was your whole group got let go. And we just saw how fragile that was and how we needed to get some other streams of income, because at the end of the day, like, the job is not loyal to you at all. They do not care. You're
Yeah.
just a number.
No, absolutely, absolutely. And so you obviously turned to real estate. That's not, spoiler. And so once you got into real estate, I would love to know, I believe you did the BRRRR strategy. Can you kind of dive into how you started building your portfolio and just provide a brief overview of your time in the single family space and maybe what strategies you were using to build your portfolio?
Sure. So we did the BRRRR method, and we actually did it in a different area. We didn't have any contacts in Seattle, and we did in Denver. And so we had a realtor friend, and he was buying them and burring them himself, but he could only do so many. So he would, if he had one that he couldn't do, he'd, pass it on to us. So we'd pick it up, and then we'd buy it with hard money. Hard money is a private loan, not through a bank, from an individual or from a group of individuals. And the interest rate is pretty high. At that point in time, we were paying 12% plus 4 points to originate, which I think is pretty similar to now. And so, pretty hefty lending. So you want to renovate it really quickly, and then you want to refinance it with the bank. So ideally, you want to create equity with your renovations so that when you go to refinance it, you get some or hopefully all of your equity back. We never got all of it, but we got some of it back, right? And so then we take that extra and put it in the next deal, and we start cash flowing off the other deal because it was being rented out. So we'd be making a little bit of money off of the cash flow, plus we got some of our equity back.
That's awesome. And so I know that you eventually obviously transitioned into the multifamily space, and I would love to know where was your head at? I mean, first, can you provide some context into where you scaled your single family portfolio to, and then what attracted you to the multifamily space if it was going so well in the single family space?
So in the single family space, I think at most we had 8 houses,
Mhm.
and we had a lot of equity because we'd had the houses a long time. And so we wanted to refinance them and get cash out and then buy more single families. But when we had first bought the houses, we had bought some underneath Sean's name and some underneath my name because you can only have so many per name. And when we went to refinance, I was no longer making 6 figures. I was being a part-time professor and I hardly made anything. And I didn't have the income to refinance the houses. So, and most of the houses at that point were in my name. So it didn't make sense any longer to keep the houses, because I changed one of the biggest mentality switches for me, because originally I was looking at return on investment. My return on investment was crushing it, right? I was like out of the park. But at the end of the day, that's great in the beginning, but now I'm looking at return on equity. And when I was looking at my return on equity, I was getting 2.7% return on equity. And I was like, if I put it in a multifamily deal, I can get 10% return on equity. I became pretty much 4 times my return by almost doing nothing. All I have to do is manage a sale and then, work with somebody to put it in their syndication. And that seemed like a home run. And once we did it, wish we had done it sooner. It was fantastic, so much easier, because even with the single families, we still got calls. We had a basement that flooded once and then it wasn't covered by insurance, and all these things that we had to manage on our end. And now I don't have to manage any of that. Somebody else does it for me.
Yeah, no, that's awesome, and that's what
And
we
it's
love.
true envelope money, right?
Yeah,
Because you get
absolutely.
money in, well, you used to be in mail, but now you get an email and you're like, I got something.
Email money. I love that. Yeah,
Yeah.
no, absolutely. And you touched on the return on investment, and then the difference. So you touched on ROI and ROE, the return on equity. Can you clarify the difference between those two for anyone that might not be sure?
Sure. So for like one example, for a single family property, initially we'd put 40 into it for down to do the BRRRR method. And then when we refinanced it, we got half of that back. So we had $20,000 in the deal. And we were cash flowing, let's say $500 a month on it at that point. So we were making $6,000 a year off of it. And we had 20,000 in. So if I look at my um, return on investment, it's $6,000 divided by my, what I left in the deal, which was $20,000, right? So that's about 33%. That was crushing it. 33%. That is
Yeah,
awesome, right? And some of the deals we had refinanced further and gotten a little bit more money out of. So one of our returns was infinite, right? Because we had no money in the deal anymore. So, that feels really, really, really good.
yeah,
But when I looked at my equity position and what I was getting my return on my whole portfolio versus my equity, I was at 2.7%, which isn't that great at all. I mean, there was other things. The property was appreciating and I was paying down debt. So I didn't factor that in my 2.7% because the appreciation maybe happens and the paying down of debt was a very, very small. But really I was looking at my cash flow position because I was like, I'm going to have to wait another 25 years to finish paying this off and then to really get the money cash flow. Or I can put it in something else and start getting serious cash flow, still have appreciation and still pay down debt, but it's just part of somebody else's bigger project. And that just seemed like a win.
yeah. No, that's awesome. That's awesome. I love that, and I appreciate you clarifying that. I mean, as you mentioned, you're a mathematician, so you love math, and that's kind of your thing.
Yes.
I would love to know, and I really wanted to ask, for any beginners who are like learning to underwrite and analyze real estate deals and opportunities, what are some tips you have from the analytical math side of things for underwriting deals, analyzing deals, and identifying a good opportunity and distinguishing it from a bad one?
Sure. I'd say number one thing is practice,
Mhm.
but the other thing is, do a deal and watch. And if you know somebody else that's running the same deal and they're going to move forward with it, but maybe it's out of your price range, you're not ready to move forward, ask to look at their underwriting and see, and you underwrite it first all by yourself, and then see what your return numbers are and see how you compare. And, if they're wildly different, then you need to go back and revisit that.
Yeah, awesome, awesome. And so you did obviously transition into the multifamily space. I believe you did a 1031 with your
Yes.
portfolio. Can you explain how you made that transition from the single family space to the multifamily, and if you want to dive into the tick structure, and how you were able to structure that in order to kind of make that transition?
Sure. So when we sold all of our single families, we wanted to put it in multifamily, but I didn't want to pay taxes on my gains, because if I did, it would have been based on my basis on that original, $20,000 that I had in the deal originally. So $20,000, and maybe the project, some of them had appreciated, $200,000 during that period of time. And that's a lot of taxes to just give away, right? I worked really hard for this equity. So we decided to do what's called a 1031 exchange. So when you sell your portfolio, it goes into a special account with what's called a qualified intermediary, and they hold your money and help you find a qualified deal. Well, you find the deal on your own, but they help you do it legally. So you can identify up to 3 properties. That's 3 addresses of properties that you want to invest in. You have 45 days from the first property selling to identify the deal. And then you have another 180 days to close. Again, I'm not an attorney or an accountant,
Yeah.
so consult a professional.
This is not financial advice.
Right. But it allows you to take your gains and put it in another deal without paying taxes. The only thing is that your basis is what it was originally. So that $20,000 for that basis for that one property remains the same. So I either need to continue to 1031 my properties, or I need to just hold it forever, or I'll pay taxes.
That's awesome. And so for that tenant in common structure, can you kind of explain what that opportunity was? I believe you did it with the Mark on that first apartment
I did it with Think Multifamily. Yeah. So when you are doing a TIC, it costs, if you're doing it with a syndication, there's significant legal costs to do it. There's about $20,000 worth of legal costs. So the syndication helps pay for those things so that you can put it into the deal, and you put them. So a syndication is a group of people that put money in together. The TIC is part of the syndication, is part of the deal, but it's not part of the syndication. It's a separate entity and a separate company. And whatever terms you negotiate, you have to negotiate those with the syndicator. They're usually similar to the same ones that the rest of the syndicator invest in, the investors in the syndication get, but it's not always the case. You should always clarify and make sure you're getting the same terms or terms that you're happy with.
Awesome. And so, of course, I believe, and correct me if I'm mistaken, but in hindsight, you probably wished you had started in multifamily over single
heck
family.
Yes. Yeah. Okay. I wish I started like first thing. I wish I'd started right away.
I love that. And we do too.
Yeah.
I mean, I think there's things we learned, and I'm sure you learned
Oh yeah.
a lot of I had a lot of learning lessons in the single family space. But for someone who's starting out and maybe is interested in real estate and isn't really sure which path to pursue, do you have any advice for which one they should choose? And would you encourage them to pursue multifamily on the onset, or what is your advice?
I mean, there's great value to both. I mean, it's easier to scale and grow a multifamily business faster. But if, there's some people that don't work well with others. And if you don't work well with others, then stick with single family. But because really, if you're going to want to jump into multifamily, you're going to need a partner or 5 or more, right? So you got to work well with others.
That's a great advice. I've never heard anyone give that piece of advice, but that's really true, because that's something we've noticed. It's such a team sport, and it's so important, 100 times more important than the single family. We were wholesaling on our own and flipping and investing rentals. That's easy to do by yourself. Really, you just need a phone and a list. But with multifamily, not only it makes more sense to have a team, but I think it's kind of impossible to do everything on your own for one person. At least you're more likely to make more mistakes and spread yourself really thin.
Absolutely.
Awesome. So I believe, you're how did you come about for that first apartment syndication, and maybe your first passive investing? Is my understanding that that's how you started out passively investing in multifamily?
Yeah, we sold one single family house first, and we invested in 3 different syndications.
Okay.
So that we could see what it was like with different operators, and we could see, just test the waters out. And that was really great. And that's how I got introduced to Think Multifamily and working with Mark and doing the TIC. And also started getting real money in the mail and it wasn't variable, right? Like you would get like your check every single quarter, and you're like, oh my, there wasn't like a weird flood that happened or something that wiped out all my gains.
Yeah,
which was phenomenal. And so after that, and watching the process of going through the TIC and selling, I was like, I want to do this. So I joined a mentorship group, Think Multifamily, which you're also a part of.
Yeah.
And it really, it gives you a place to ask all your questions and, where to get started, and it's, you can certainly start on your own, but going with a mentorship group is definitely helpful because it's laborious and it's, easy to get stuck. And then there's other parts of the process where you're like, I need someone to co-sign with me. I don't know anyone that co-signs. I need to raise $2 million. How do I do that? Right. So doing the mentorship group is very helpful. So after I joined, I started looking for deals. I originally started looking in Phoenix, and that didn't pan out. It just was too expensive at that
Mhm.
time for the rent ratio. So I started looking in Kansas City, and I found a deal that looked promising. And I found it on Thursday, and I flew out over the weekend and saw it on Monday and met a property manager, and it seemed like a really good fit. And so we moved forward with that. And we actually listed that property recently, and getting some offers in. I'm sure this
So
isn't going to
awesome.
air this week, so I can go ahead and say it. But it's looking very promising. I think investors are going to be very, very happy.
That's awesome. I didn't know that. So that's really cool. Full circle moment, right? This
Yeah.
is your first full term, right? Or
Yes.
full
This will be
cycle.
my full
Sorry.
cycle.
Okay.
Yeah.
Awesome.
Yes.
Awesome. That's so congrats. That's really cool.
Thanks. Yeah.
There are a few things I want to dive into there. First, can you kind of explain or expand on how long it took you to find that first investment opportunity?
Yeah, it took a long, long, long time, no, to find the first one. Like it just felt like it took forever, right?
Mhm.
But it didn't take that long. Probably I'm one of the faster people within Think Multifamily to find a deal.
Mhm.
So, but it took me, it was in the group for about 4 months before I found my
Oh,
first
wow.
one.
That's
Yeah,
awesome. That's really cool. I
yeah.
love that. So,
But 4 months feels like a long time
no,
when
it
you're like
does.
really grinding.
Yeah, and that's why I want to dive into that because people probably, for the most part, they see the wins. They see you
Yeah,
getting your deal. They don't see the amount of time and effort and L's that you took along the way. So can
yeah.
you explain how much work went into underwriting? How many deals do you think you underwrote until you got to that deal? And then also, you were able to kind of, it sounds like you were just able to drop things and go visit the property. How important is it to be flexible in that way? And how did that help you really put yourself in the best position to win that deal?
Sure. So I'm going to go with getting the deal first. So
Okay.
now that I'm on the sell side, I can really see like the feedback that the broker gives to the seller.
Mhm.
And one of the things is on the list is, did they visit the property? Yes or no? And, that's a big indicator, because if they haven't seen the property, like, and then they go see it later, they might
Yeah.
change their mind. I jumped on the plane right away, and that was really powerful because it showed I was interested, and that I could, I was flexible, and that I wanted, like, I was really interested. So that really helped. And
Mhm.
I didn't get the property right away. It went to somebody else, and they couldn't close. And then I was the second highest, and they came to me. So you never know. Sometimes you might not get it right away. It might not mean that you didn't get it forever.
Mhm.
And then the first part of the question I forgot.
No, it's okay. It's about being flexible and being able to kind of drop everything and
Oh
go
yeah.
and
It's
having
super
that.
important, right? You have to be able to go to the markets. You have to meet the brokers. Otherwise they don't take you seriously.
Mhm. Absolutely. And can you also maybe address how many deals, if a rough ballpark of how many
Oh,
deals it took you to look at before you got that one?
okay. So this is the first deal that I made an offer on, and I got it. So I'm not a good example
It's
for
an
that.
anomaly.
Yes, some people are like 100, right? But I certainly underwrote tons of deals
Mhm.
beforehand. And because I was part of the mentorship group too, I underwritten them and then
Yeah.
shared them with my mentor and been like, what do you think of this? And had them be like, why did you pick that number? That's
Yeah.
weird, you know? And so
Yeah.
gotten some feedback along the way to
Awesome.
refine my, underwriting skills.
Yeah. And I think you're in a really interesting position right now where you're selling your property and this is the first time you're selling one on so you're seeing it from a really interesting perspective. Do you have any lessons for someone who might be a new buyer or looking to purchase a large multifamily property as someone who's currently selling? So what are some pieces of advice you could give maybe?
I would say what I've learned is you can ask the broker, like be really blunt and say, where do I need to come in at to be invest in final? And if they like you and you have a good rapport with them, they'll give you a range,
Yeah.
right? Which is nice. So you can go ahead and be aggressive. Where do I need to be with earnest money? You can ask those things. They might not answer them, but go for it. Ask them where you have to be, so that you're not wasting each other's time,
Yeah.
right? And then also the other thing is that brokers really like to get a lot of offers, a lot in. And so sometimes they're going to ask you for an offer and you're just like, I'm wildly off. They still want you to submit it, and that builds rapport with them. So you can say, well, I'm coming in at 10 and you're asking 14. Well, they might say, well, go ahead, write it up.
Yep.
But they do mean it. They do want you to write it up, and it does help build rapport. So just go for it.
Yeah, no, that's awesome. I appreciate that. And just backtrack a little. Obviously, we mentioned that you're in the single family space, and in the past, I've heard you kind of explain there's risks to both, and you have to make some trade offs when it comes to investing in multifamily over single family, or vice versa. Can you, because a lot of the people in the audience might be investing in single family, and be comfortable with the risks there, but aren't really familiar with the risks in multifamily. Can you address what the risks are maybe for single family and multifamily, and why for you it made more sense to pursue multifamily even with those risks?
Sure. So on single family, you're individual. You're betting on one horse. You're betting that this house succeeds. You're betting that you have good tenants. You're betting that everything is great. When you do multifamily, you're betting that these 200 units perform, right? Either scenario, there is a chance that you're going to have a roof cave in or something, right?
Yeah.
And then if you own it long enough, something bad's going to happen. It just is what it is. There's no justification. Just
Yep.
like fires happen, stuff happens. So but with a multifamily property, you might destroy, 2 or 3 units, right? And that is devastating, right? And it, obviously affects families or something, but we go in there and we fix it quickly and we get it up and going. So our scale of risk is small, right? Because we've affected 3 over 200 units. Now on the single family side, also you can have something happen and it's the same scenario, right? Except that when that one happens, like your risk is so high. Like,
Yep.
Like when we had that flood in our basement, it wasn't covered by insurance. We were having a rough go with our property management at the time, and they were being very slow about finding somebody to come in and replace it. So my husband quit. I mean, not quit. He took like 5 days off of work, went to Denver, found a contractor, helped get some of the stuff work going, like get all of the wet drywall out because it was starting to mold. And our property management was being very, very slow about getting a crew in. And, it's our asset, right? Like if the mold grows everywhere, our asset could be worth nothing and it's not covered by insurance at this point. So we need to fix it. So as an individual, the risk is all, the time risk, the money risk, it's all in that one scenario, especially if that property isn't right next door. The risk is high because then you don't know exactly what's happening.
Yeah.
Yeah.
No, that I completely agree. We actually recently were selling one of our rentals because we had to evict the tenant. He completely ghosted us and we weren't able to contact them. We even sent a police officer over multiple times to check in on them. And we were responsible for paying, the debt on it, even though we had no one paying. So if that were to happen in a multifamily property, it wouldn't really have that much of an impact because you have.
Right. It would just be one unit
exactly
out of the many, right?
Exactly.
And then I would say for the syndication, the other risk is, that you want your operators to be invested in the deal. You want them to have money in the deal and you want them to be like invested in the success of it. That's really important. Like something that I always say about my syndications is that my mom and my sister put money in and I can't lose their money.
Yeah. It's got skin in the game.
Right? Like, I mean, my money is one thing to lose, but like my sister, I cannot lose her money, right? She has 7 adopted kids. And for a long time, she was the sole breadwinner. So like that money is hard come for them.
That's awesome.
So make sure that like your syndicator, like you really trust them because the way that they're treating you when they're trying to get your money too is the best they're ever going to treat you.
That's a great piece of advice. And I agree. Having skin in the game is a great way to align interest when it comes to the general partners and the limited partners. So that's awesome.
Yeah.
I do want to, it's not necessarily a pivot, but I did some research and we've talked about it in behind the scenes as well. You had a gym business and you can kind of provide the story of how that went and maybe why you chose to pursue other ventures like real estate afterward. But can you also maybe answer the question of how did that experience kind of, I want to make sure I phrase this correctly. What are the benefits of being in business like real estate over pursuing a venture like a gym?
Okay, so we read the second Rich Dad Poor Dad book, the cash flow quadrant book, right? And we were like all fired up. We're like, we're gonna be real estate investors. We're gonna own businesses.
Yeah.
We got this. But then we were like, wait, we don't know anything about business. So we decided we're gonna do a franchise because the franchise knows about business. So we had 2 gym franchises of Anytime Fitness, and their corporate support is very, very good. And one of the gyms was in a town that didn't necessarily perform really well. The other one did really well, was in the top gym performer, was profitable, right? For a small business, being profitable, we were profitable in within 6 months. That's huge, right? And it's a cash flow business, the same as a rental house, right? People pay for memberships and, if they do quit, you got to replace it. But there is a grind to owning your own small business because it wasn't like I invested in a business. It was my business. So when somebody called me the night before and said, I'm not coming in and I couldn't find somebody to replace them, it was me working there. I was the one scrubbing the toilets and I am a bad toilet cleaner. It's not even that I don't like it. I just do a bad job and I know it. right? And then my husband would come in the next day and be like, the bathroom's filthy. Who cleaned this? And I'd be like, it was me. It was terrible. And then, it's a low maintenance business in some ways because it's relatively low staffing, in Anytime Fitness, you usually have, 2 to 7 staff members, right? But
Yep.
because you're relying on 2 to 7 people, and chances are they're in the age bracket of 20 to 27 that are working there, they are not the most reliable folk, right? They went to decide to go to Coachella, right?
Yeah.
Good for them, but
Yeah.
bad for me. And so it was profitable. And then the other thing with the gym and a lot of other businesses, we were pretty profitable, but we reached a point where we were like, we could get more profitable, but it would take so much more effort to get that extra profit. And so we listed it on the market, and then COVID happened.
Yeah.
And we had over 50% of our gym memberships quit within, a month. And Sean and I had a really tough conversation with each other. And we said, is this going to be a long problem or a short problem? And we said long. And we decided to drastically cut the price of our gym, and we didn't have any debt on it. So that was okay. And we just said, let's cut it because it's already been a time suck. We knew it was something we want to sell. It was painful because as a business, you put a lot of energy into it and time, and, it's your baby, but we sold it. And honestly, it was one of the best things that we've ever done.
That's awesome.
It was such a time suck. And now I've been able to 100% focus on multifamily. So it's worked out great.
Yeah, no, that sounds good. And I just really, because I think a lot of people will confuse, there's 2 different kinds of businesses. I mean, there's so many different kinds of businesses, but that's a different kind of business than real estate.
Oh yeah, totally. And you can get a bigger business where you're the CEO and you're there sometimes, right? That also costs a lot more money. And that was out of our price range of that. So.
Yeah, no, absolutely. And so, I know that you're kind of in a different phase of your business and your investing, I guess your investing phase of your journey, for lack of a better term, but you're a big advocate for diversifying your portfolio. And I was really curious, first, can you kind of explain what diversification is, and also dive into how you're diversifying not only within real estate, but potentially looking to diversify within things outside of real estate, and why that's important?
Sure. So I put my money in different asset classes, not just multifamily. So recently we partnered on an Airbnb. And there's other opportunities, within real estate. You can do single family, you can do multifamily, storage units, et cetera. There's a lot of spectrum along the way. And you can diversify in the, cities that you're in, right? So I'm not all in the same city, which is great. And then within that, there's, risk classes, right? For some cities are more risky, so the return will be higher, right? If you're in a smaller city, the return will be higher. But if you're in Atlanta, it's a very sexy market, you might be getting a little bit less return. So that's the same for asset classes within multifamily, like a corporate lease where somebody pays triple net lease and that, it just comes every month, your return is going to be less than something that's higher risk. So being diverse in your risk, your areas and that type of thing within real estate, I think is important. And then outside of that, you want to be diverse. And most importantly, I advocate for is making sure you have a spat amount in the bank, just in case. You never know, my husband still works, what if he loses his job, or, who knows? So you want to be able to, have a good security net. And then also I would suggest, there's plenty of other ways to invest, and you want to make sure that you're doing other aspects of it as well. And I'm not an expert at any of those, so I'm not going to speak to them specifically.
No, for sure. And I know that a lot of investors are advocates for having cash reserves and just having something liquid so that you can make a decision if something does happen.
Absolutely.
It's really important. So I appreciate you sharing that. In the past, I think it was at the Fire Summit when we were talking, and we were chatting, and you kind of mentioned that you're in this new phase of your investing journey where there's, not necessarily levels, but you're at the point where, okay, you have some wealth and you're ready to kind of continue to grow it. It's a different phase from building wealth from the ground up. So I would love it if you can kind of paint, or provide some context into where you are there and how you're growing your wealth once you have some of it.
Yeah, absolutely. So I'm going to speak to this as a syndicator. So if you are a syndicator, you get a portion of the equity in the deal, but that part of that syndication doesn't really cash flow. And if it does, it's not very much. So your return on syndication equity, like the money you got on the deal, is very small, if not zero. So that's one of the reasons why selling Pin Oaks made sense. One, it's going to make investors very happy, but two, I can take that equity out and reinvest it someplace where I'm going to get cash flow. So I'm at a point now where I'm actually actualizing some of my gains that I started working on, 2-3 years ago, which is phenomenal. So I can reinvest that, increase my cash flow, and make it to, more comfortable life, right? Because like ultimately the goal for everybody is that, you and your partner or you and yourself can just quit and do this full time and, unplug for a month and go to the beach, right? And so we're not quite there yet, but, now I'm kind of feeling like we're moving in the right direction, because
Yeah.
there was a while, I think that with cash flow or wealth, sometimes you kind of see these big jumps and plateaus, right? And I was kind of seeing that we've been plateauing for a while. So this is, really great to actualize some of it and to be able to realize, cash flow gains in the, by selling this and reinvesting.
Yeah, that's awesome. And I think that is the goal, because it's not necessarily a game, but it's like you have to continue to grow it once you have it, because if it's not growing, it's dying. And, so I appreciate you sharing that. And I do want to back up a little bit about you, kind of what the process of finding deals. And I believe you are the only woman to be a lead sponsor in our group. And there's not, of course, it's not a secret that there's not that many lead sponsors as female lead sponsors. So I would love to know, I mean, just from your perspective and your experience, has there been any challenges, whether it's from other people or maybe just a mindset, when it comes to leading a deal and starting your multifamily journey, and maybe throughout the journey as well, even today?
It is, I mean, it's hard to do no matter what,
Yeah, for
who
sure.
you are. So it's definitely challenging. Leading a deal as a female, I think, is extra challenging, right? When it was my first deal, I led it by myself. There was more than one person who was like, "Are you sure you can do this? Are you sure?" And I was like, "I'm not sure, but I'm still doing it." And then even afterwards, I had two people come up to me and said, "You wildly overpaid for that. You're going to be so sorry." Which turned out to not be the case. But I think no matter what, you're going to have detractors, whether or not it's friends or acquaintances. Also, when we switched, when I first started investing in single family, one of my best friends said, "I need to come over. I need to talk to you and Sean." And I was like, "Okay." And they came over and they're like, "I think you guys are making the biggest mistake of your lives. You are going to end up bankrupt. Please do not buy these single family houses." So it's hard to make the decision to move forward, right, on things anyway. But then if you have somebody that you know and trust, and then they're telling you this is a stupid move, it makes it even worse.
No, yeah.
So, and I think people are more likely to say those things to you if you're a female, like to second guess your pathway to success. So just dig deep. And then also I'd say I have a really good network of girlfriends, and don't hesitate to, like I would just be like, "I can't do this anymore. I'm like, this is so hard." And they're like, "Suck it up. You told us like 1,000 times this is what you wanted. Now you're getting it. Now you're telling me you're too scared to move it and make it happen." So, and so I would say it's okay to tell people you're scared. Don't tell your partners you're scared, because that's generally bad.
Yeah.
Right. But find somebody else you can talk to and tell them that you're like overwhelmed and this feels like too much.
Yeah, no, that's awesome advice. And so you mentioned that a friend told you that. We're big believers in only taking advice from people you would trade places with, and being very cautious with who you take advice from. How did you, I mean, who are you taking advice from, and how are you kind of like determining who you should take advice from and who you shouldn't?
Well, obviously we didn't take advice from them because we continued forward. But I would say, one, you pay, like I'm paying to be in the mentorship group, so I'm certainly taking their advice. And then I've joined another mastermind type group and learning from other people that have been through the journey as well, and not being afraid to ask the questions. That's why you join these groups. And you certainly don't have to. I mean, you can join a Facebook group, but reach out to people, ask to meet them, take them to coffee or Zoom call and just ask them. You'd be surprised at how open people are. People are excited about what they're doing. They're excited that their wealth is growing. So they're not going to be like embarrassed and be like, not want to talk to you about it. They're excited that somebody actually cares enough to ask them about it.
Yeah.
So go for it.
That is awesome advice. I appreciate that. And we are now in it's time for our final question round. Are you ready?
I'm ready.
Awesome. We call it the speed round. So
Okay.
the first question will be, what has been the biggest failure or learning lesson that you've encountered along your journey in real estate or investing? And what did you take away from that experience?
I mean, I've had a lot. One of the biggest was with single family. I had a contractor walk off the job after we had paid him a significant amount, and just learning, you can't always trust people, and to have a backup plan. and also learning what I'm good at and what I'm not good at. And some things with that regard, I definitely could have done better. But what I would have done even better was hiring someone else to do it for me.
Yeah. So how has that kind of manifested itself in multifamily today? Like, what are you doing to trust but verify or, um,
Well, I would say I'll go to the asset management side.
yeah,
So for me, asset management isn't my forte. So where I can, I get somebody else that is more qualified to do it for me.
awesome. Awesome.
Yeah.
So that's great. And so to kind of look to the future, what are you aiming to accomplish moving forward and what are your long-term goals?
So probably I'm aiming to accomplish is I'm a short-term thinker. So my short-term goals would be sell this property, make investors really happy, find something else to put it in and get some sweet cash flow. And then, see where the market is after that and then go from there. I'm not that long term. My husband's the long-term planner. I'm not.
I love it. I love it.
Yeah.
This is an additional question. I'm just curious. What is your why? What drives you to pursue multifamily deals and kind of gets you through the hard times that I'm sure you've encountered and will continue to as a real estate investor?
And the biggest thing for me is to be able to offer experiences to my children. I want them to be able to do fun things. And my parents certainly did the best they could for us to do lots of fun things and have adventures. But, things are more expensive and I want to do more adventures. So that's my biggest
Mhm.
driver.
That's amazing. I love that, and I also share a similar why, so that's really cool. I
Yeah.
don't have kids yet, but when I do, when I do. Um,
Right.
so you've shared a lot of value today. I appreciate it. But if there was one gold nugget or a piece of advice or wisdom you'd want someone in the audience to walk away with from this episode, what would that be?
If you're stuck and you're just spinning your wheels, don't like that's not helpful, right? Reach out to somebody and say, I am stuck and I don't know what to do. And if that person doesn't give you a raise, try three more, right? Until you get like going because it's easy to just spin your wheels and not do anything.
Yeah, I completely agree. Analysis paralysis will destroy you. So great,
Absolutely.
great
Yeah.
advice. And if anyone in our audience wants to learn more about you or what you have to offer or access any of your resources or anything like that, where can they go to find out more?
I'm at bigfootequity.com or you can email me at carmen@bigfootequity.com.
Awesome. Thank you so much for your time, Carmen. I really appreciate it. It was a pleasure chatting with you.
Thank you so much for having me.
Absolutely.